My parents say, oh man, I can't believe I'm going to say this, but being lazy is actually an amazing strategy when it comes to becoming wealthy. Doing nothing is sometimes the best decision that you can do. It sounds counterintuitive, but when you look at the numbers, it actually makes total sense. What's up, guys? Brian here from Ride Your Money Wave, and recently you guys have been emailing me getting all excited about getting serious with your money. I've gotten emails from former students and from strangers alike, viewers like you. I sound like PBS. Viewers like you emailing me saying, hey, thanks for doing this. I'm tuning in. When's the next video coming out? And asking for specific advice about getting ready to start investing. And while that is great that you want to follow rule number 1, that no one cares about your money as much as you do, the reality is that you can't just go up to the high dive and jump into the deep end. Doing so, you are going to hurt yourself. You're going to lose money and you might get scared away from investing again. And so we want to introduce you to investing by slowly bringing you in the shallow end. Notice that I'm saying we want to introduce you to investing. From the emails that I've been receiving, you guys want to trade. You're asking, what are the best stocks to invest in? You know, what account should I open up so I can start buying companies? It's like, whoa, hold on a sec. There is a big difference between trading and investing, and really that's the first thing that we need to introduce. Now, years ago, it seems like years ago when I was actually in a classroom teaching this stuff, but I would sometimes have students come in and they would raise their hand and they would say, my parents say that the stock market is like gambling. And I would just sit there quietly and just kind of take a deep breath, find my patience, and then I would have to explain to them. Go into a casino. And casinos are largely driven by probability. What's the probability you're going to roll a 7? What's the probability you're going to get an ace? What's the probability that you're going to get 3 cherries across your slot machine? Those are all based on probability. Nothing that you can actually do to increase those odds. But the stock market, on the other hand, investing is not based on probability. Sure, there's tons of numbers. There's tons of math. We like to look at averages and valuations and stuff like that. But overall, when you are investing in the stock market, you are buying assets. You are buying human capital. I own Amazon stock. So when Jeff Bezos wakes up, I own a portion, a very, very small portion, but a portion nonetheless of Amazon. And therefore, when he goes and wakes up and goes to work and he has the incentive to make money, guess what? In a very, very, very small way, he's working for me. Because when he makes money, I, as a shareholder, make money. By investing in the stock market, is there risk? Of course. Is there a probability that you're going to make money or lose money? Sure. But overall, what you are doing is you are investing in a pie that is growing, and that pie is wealth. And so if you own a slice and the whole pie begins to grow, the size of your slice of pie begins to grow as well. In short, you are buying assets. That's the difference between the stock market and a casino. But what about trading versus investing? Judging by some of your emails, you guys want to jump in and you want to start trading. Trading is largely based on the short-term price fluctuations in the market. And those fluctuations can derive from news, algorithms, high-frequency trading, and trading is betting on those short-term price fluctuations. You're essentially betting on an irrational psyche of the market. You're trying to anticipate the psychology and the decision-making of mass herds of people. Well, good luck with that. I mean, even Sir Isaac Newton said, I can calculate the motions of heavenly bodies, but not the madness of people. If you're like me, when you click on YouTube, you see these ads that are promising you how to teach you how to trade. Listen, there is no get rich quick. You need to understand that. If those people were so good at trading, they would focus all of their time and all of their energy on trading because they could make way more money either using leverage or creating a hedge fund and using other people's money and collecting some of the profits. That's the way hedge funds work. They could make way more money just spending all their time trading. So why are they so benevolent trying to teach you how to trade? Well, it's because that's the way that they're making their money. Guys, there is no get rich quick scheme. It took me 13 years from the time I graduated college until the age of 35 of always working at least 2 jobs. One job dedicated solely to investing, meaning that the profits or the money that I was making was always going towards the stock market, was always going towards buying assets, trying to max out my Roth IRA, maxing out my 403b, maxing out my 457, maxing out my SEP IRA, then finally opening a brokerage account when all of those were already maxed out. It took me 13 years from 22 to 35 before I finally had a net worth of $1 million. That was 60 hours a week minimum. That was 6-7 days a week working. I went one summer where I looked at it, I had 3 days off from May until October. That was it, 3 days off. So you cannot get rich quick. Maybe some people can, but it is such an anomaly. Investing in the stock market, if you want to get wealthy, A, I think that's one of the best ways because it can be passive. But B, in doing so, you need to be patient, you need to be persistent, and you need to be disciplined with your money. And which is why we're doing this video, because what I want you to do, I want you to actually be incredibly lazy when it comes to your money. I don't want you to be a trader where you're in and out of stocks trying to time the market. That's a great way to lose money. Instead, what I want you to be is a buy and hold long-term investor. And so that's what we're going to be looking at today. That's what we're going to be looking at in this video. And I want to point out 2 different things. One is I want to show you the actual average returns of active investors versus simply buying and holding the S&P 500. By trying to time the stock market, you have to be right twice. You have to be right when you sell if you think the market is going to be going down, you got to be right at selling at the top, and then you have to be right when you buy in at the bottom. And doing so is incredibly difficult. J.L. Collins, in his book, A Simple Guide to Wealth, or A Simple Path to Wealth, he explains using statistics that over a 20-30 year period, the number of people who do this is next to 0%. It is a fraction. I mean, we're talking the absolute world's best. Just a handful of people who can beat the market. Even Warren Buffett, considered like the godfather of value investing, he's struggling to beat the market from 2015 on. The S&P 500 is beating Berkshire Hathaway. Even the world's best, you got to know that sometimes, they can't even beat the market. Even Warren Buffett believes in the power of the S&P 500. He made a bet to hedge fund managers, people whose job it is, with billions and billions of dollars worth of research behind them, to beat the market. He said, listen, over 10 years, I bet you $1 million the S&P 500 will beat your hedge fund. And if he won, if Warren Buffett was right, he would donate that money to a charity. And if the hedge fund won, he would give him $1 million. So there was nothing to lose if you were a hedge fund manager. If you won the bet, you get $1 million. If you lost, you owe nothing, and $1 million goes to charity. And as it turns out, by the end of year number 8, Warren Buffett had already won the bet. The problem for today is his 5 funds through the middle of the year have only been able to gain 2.2% a year since 2008, compared with more than the 7% a year for the S&P 500. That means that $1 million of hedge fund investment would only earn $220,000, but Buffett's S&P 500 would earn $854,000. Here's the problem when it comes to active investing, is that it costs money. Whether you're dealing with actively managed mutual funds or whether you're dealing with your own individual investing, is that it costs money to buy and to sell. And so if you take a look, Jack Bogle, the founder of Vanguard, he even says it best when he says, "The grim irony of investing is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for." In other words, by buying an index fund, which has a very low maintenance fee, more of your money goes to work into the market and continues to earn compound interest. And less of your money goes to management fees, goes to the brokers, goes to the advisors, goes to the mahogany desks and the marble floors and the fancy glossy brochures. Your money goes to work for you. God, doesn't that sound familiar? By being an investor, that is, by buying and holding stocks for a long period of time, particularly the S&P 500, what you're doing is you're accepting the strategy of saying, hey, you know what? I don't have a crystal ball. I can't sell at the peak and buy at the trough. And so instead, I'm going to accept the worst days, but I'm also going to capture all of the best days. And so let's take a look at some data here. Over a 20-year period of just buying and holding the S&P 500, that is from January 1st of 2000 until December 31st of 2019. If you were to just simply buy and hold for all 5,035 trading days, you would have an average annual return of 6%. Not bad. But if you were to actually try to buy and sell and you missed just 5 days, if you missed the 5 best days that the S&P 500 really popped, it was a really bull market. Think about that. That is 0.1%. Not the top 1%, the top 1/10 of 1%. You know how difficult that would be to try to say, hey, out of 5,000 days, these are going to be the 5 best? It's next to impossible. But if you did so, your average return drops from 6% down to 3.87%. If you did the top 10 days, if you missed the top 10 days, you are down to a return of 2.4%. And if you miss the top 20 days, you are basically breaking even at 0.07% return. You hold on to your money for 20 years and you are breaking even. And that's not including inflation. If you miss the top 40 days, then you are out 3.8%. You're actually losing money. Here's what I want you to do. I want you to buy and hold. I want you to be incredibly lazy. And there's a system for you to be incredibly lazy that will actually encompass all of the things that we were talking about today. It'll be the S&P 500. It will be buying and holding through all the good days and the bad. It will embrace the low maintenance fee. And best part yet is that it will even do work for you. It will rebalance that portfolio every year to make sure that the risk profile is appropriate for your age and when you plan on retiring. And how do we do that? You buy a target date fund. So to all of the people who have recently been emailing me saying, hey, I want to get into the stock market. I want to take control of my money. I want to be the master of my money. You know, what's the next step? What stock do I buy? You don't buy just one stock. What I want you to do is I want you to buy the entire stock market. Not only the entire US stock market, the entire world stock market. And then I want you to balance that with US bonds and the entire world's bonds. And you can do all this by buying just one fund. It is like the fund of funds. It's this umbrella. You buy a target date fund, and underneath are these 4 separate funds. And what happens is that's the only thing you need to do. We can make you wealthy by just 2 choices. Remember, on this podcast, we are huge on making big, great decisions. Great, big decisions? Whatever. One of the 2. I just need you to do 2 things. Number 1, buy a target date fund. And number 2, invest in it automatically. Every paycheck, just put 20% of your paycheck into that target date fund. Go out there, go live your best life, go to concerts, have bonfires, have cookouts, sleep in, watch Netflix. I don't care. Do whatever you want to do. As long as you do those 2 things, you will wake up very, very happy and very wealthy when you get older. And then you can re-examine your decisions and make a second great big decision, which is what is going to be what we call your glide path, your retirement withdrawal rate when you finally start to pull that money out. But listen, that's like 30, 40, maybe even 50 years from now, depending on how old you are. So we're going to worry about that when we get there. Right now, I want you to be lazy. Did you hear me? I want you to be lazy. Just make 2 decisions. Number 1, invest in a target date fund. Number 2, make it automatic. And number 3, hit the like and subscribe button to this video so that we get bumped up on the algorithm and you can tell your friends about this so we can all become wealthy together. Just to reinforce how lazy I want you to be, let's take a look at some numbers. Let's assume you set this up, invest in a target date fund, and make it automatic, and you put $300 a month in, starting at the age of 25, and it returns 8.6%. Now, why do we pick 8.6%? Because that is the historic rate of return for a traditional 60-40 stocks and bonds portfolio. Now, is that what you're always going to hold? No, of course not. When you're younger, you're going to hold more stocks. You're going to be taking on more risk, so you should see a higher return. And when you're older, you may have 40% bonds, maybe even 50% bonds. But we're just taking a relatively conservative number of 8.6. If you were to put $300 a month with 0 to start into this target date fund and it returned that, you would have $1.2 million when you're retired. Now think about that. That doesn't include pay increases. That doesn't include 401k matches. That doesn't include, you socking away more money when you start paying off different debts. So this is a baseline. And if you do this in a Roth IRA, that is all tax-free money. All right, guys, so there you have it. This is why I want you to be lazy. It pays to be lazy. It pays to buy and hold. It pays to invest in a target date fund and to make it automatic. In doing so, you will wake up one day a very, very wealthy person. It's not tough. The system is already in place. The hardest aspect of this is controlling your own emotions. Utilize this information, share it with a friend. Do me a favor, hit that subscribe button, hit that like button, help me out, and use this information so that you can go out there and go live your best life.